Welcome to the Deep Dive. Today, we're jumping into a really fascinating space, microcap biotech.
It really is. It's where you find these potentially world-changing medical ideas.
Right, butting right up against some, well, pretty harsh financial realities and sometimes unexpected things like global events.
Exactly. And today we're focusing on one company in that exact spot, Phio Pharmaceuticals, ticker PHIO.
So we've gathered a whole stack of research here, analysis, public filings, news, all current as of early June 2025.
Yep. And our goal is basically to unpack it all for you. What does Phio actually do? What's their core technology? What are the key pressures and opportunities they're facing right now?
We want to give you the core insights straight from the sources without you having to wade through all the jargon.
Think of it as getting you up to speed quickly on this specific company, but also giving you a feel for the dynamics in this whole biotech sector.
Yeah, highlighting the stuff that really jumps out from the research.
And, putting together these deep dives, pulling insights from all these different places, well, it takes some serious analysis. We'll actually tell you a bit later how you can even get a deep dive like this focused on a stock you're interested in.
Okay, sounds good. Let's get started. Phio Pharmaceuticals. Fundamentally, what's their business?
Right. So their main focus is immuno-oncology, basically using the body's own immune system to fight cancer.
Okay.
And their core technology, the thing they're really built around, is called INTASYL.
INTASYL. Okay, I saw that mentioned. What's special about it?
Well, it's what they call a self-delivering RNA interference platform, or siRNA for short.
siRNA.
Yeah.
That rings a bell. Gene silencing.
Exactly. It's a natural process cells use. INTASYL uses synthetic siRNA to silence specific genes involved in cancer or immune responses. But the key phrase here is self-delivering.
Meaning?
Meaning, unlike a lot of other RNA or gene therapies that need, say, a virus or a special fat bubble, a lipid nanoparticle to carry the drug into the cell, INTASYL is designed so the drug molecule itself can get into the target cell. No separate delivery vehicle needed. That's the pitch.
Okay. So potentially less complex. Easy to deliver.
That's the hope. That's the potential advantage they're trying to develop. Overcoming those delivery hurdles is a big deal in this field.
Makes sense. All right, the million-dollar question, or maybe the $0 question right now. How do they make money?
Yeah, well, right now they don't. Not from products, anyway. The sources are really clear on this. Zero product revenue. Nothing's approved for sale.
So where does the cash come from?
Equity financing. Selling stock. That's it. Their entire future hinges on getting their drugs through trials, getting regulatory approval, and then selling them. Or maybe striking a licensing deal with a bigger company.
And that revenue, if it comes, is way down the line.
Oh, absolutely. Their lead drug is only in phase 1B trials. So yeah, we're talking years, potentially many years away.
Okay. So what are these drug candidates they're working on with this INTASYL tech?
The main one, the lead program, is PH762. This one targets the PD-1 gene.
PD-1. That's
Yeah.
a common target in cancer immunotherapy, right? Checkpoint inhibitor stuff.
Exactly. It's a gene that cancer cells often use to hide from the immune system. So PH762 aims to silence that gene within the tumor environment. It's in phase 1B trials for skin cancers, things like cutaneous squamous cell carcinoma, melanoma.
And how's it administered?
That's a key point from the research. It's positioned as a potential non-surgical, locally administered treatment injected right into the tumor.
Ah, okay. Local delivery. That could be significant for skin cancers.
That's the idea, targeting that niche. The trial number, if you want to look it up, is NCT-TSHAG 06014-086.
Got it. Any other major candidates?
There's also PH894. It also uses INTASYL, but it targets a different gene, BRD4. The goal there is different, too. It's aimed at boosting natural killer cells, or NK cells, for use in adoptive cell therapies.
So cell therapy enhancement.
Right. They presented some data on that back in April 2025.
So these two main programs, PH762 and PH894, both built on that same INTASYL platform.
Yep. And that's actually a really important point that comes through in the analysis. They're very focused on this one technology.
Which could be good or bad, I suppose.
Exactly. It's a strength if the platform works brilliantly. But it's also a concentrated risk, right? If there are fundamental problems with INTASYL, it hits their entire pipeline.
Okay. Let's talk scale. How
Right.
big is Phio? You said macrocap?
Oh, yeah. Definitely micro.
Yeah.
Market cap floating around 14.2 to maybe $13.35 million in early June 25. One source mentioned maybe closer to $9.6 million, but either way, it's tiny.
A smaller reporting company, according to the SEC.
That's the classification. And operationally, This was kind of startling.
Yeah.
As of June 2025, the sources say they reported having only 5 employees.
5. Seriously. To run clinical trials and develop these drugs.
I know, right? It's incredibly lean. It almost certainly means they rely very heavily on outside contractors, CROs, consultants, you name it.
Keeps the internal headcount low, but maybe not the overall cost.
Well, their G&A expenses were still about $1 million in Q1 2025, which, for 5 employees is pretty substantial. Suggests a lot of external spend or maybe high executive costs relative to the headcount.
So pulling that together, their value proposition is really all about the potential of INTASYL.
Yeah.
Solving RNAi delivery, targeting genes locally, maybe offering non-surgical skin cancer options.
That's the core narrative. That self-delivering aspect is the key differentiator they're pushing.
Okay. What about the playground they're in? The industry?
Well, they're positioned in some high-growth areas, no doubt. Biotech generally, immuno-oncology, which is forecast to be a massive market, like over $111 billion by 2034.
Wow.
Yeah, growing fast. And RNAi therapeutics itself, also growing nicely, projected over $5 billion by 2034. So the general market trends are favorable.
Oh, competition. Must be fierce.
Oh, incredibly fierce. You've got giants like Moderna, Alnylam, Arrowhead, companies with R&D budgets that just dwarf Phio's. Phio spent maybe $3.6 million on R&D in 2024. Alnylam spent, like $731 million?
Yeah, that's not even comparable.
Not even close. Plus, they're competing against all the other types of cancer treatments out there, too. And the regulatory hurdles are massive. FDA approval is a long, expensive, uncertain road.
Any silver linings on the regulatory front for RNAi?
A small one. The sources did point out that the FDA has actually approved 6 RNAi drugs as of May 2025. So the pathway exists. It shows regulators are willing to approve these kinds of novel therapies, even if it's still a relatively new area.
What are the main things stopping others from just doing what Phio's doing, the barriers to entry?
Money, mostly. The sheer cost of R&D sources estimate anywhere from $160 million to maybe over $2 billion to get a drug to market.
Oof.
Yeah. Then there's protecting your intellectual property, your patents. That costs money, and fighting patent challenges costs even more. Running the clinical trials themselves is hugely expensive and risky. Plus, you need really specialized expertise and manufacturing know-how. Phio's own patents, which run into the late 2030s, are a key part of their defense.
But despite all that, the overall industry seems like it has legs, a solid future.
Looks that way, based on the analysis. There are still huge unmet needs in cancer. Science keeps advancing, and the market forecasts and regulatory acceptance are trending positively. Phio's specific focus, like non-surgical skin cancer treatment, fits right into that future picture.
So given the competition and barriers, what's Phio's edge, their competitive advantage, or moat?
Well, brand recognition isn't really it. They're not a household name, except maybe among specialists.
Right.
No cost advantages, obviously, being so small. No network effects in the usual sense, although good scientific results can definitely create buzz and attract talent or partners.
Switching costs could be high, maybe, if their drug really works better.
Potentially, yeah, for partners adopting the tech or for doctors prescribing it. But the real unique assets are, number 1, the INTASYL platform itself. That self-delivering claim is the core differentiator. Number 2, their patent portfolio protecting that tech. And number 3, arguably the most important right now, the emerging clinical data, especially those early positive signals for PH762, like the complete responses mentioned. That's tangible validation.
So what makes it hard to copy?
It's that proprietary tech and the patents around it, the specific chemical tweaks, the know-how. Plus, you can't just copy clinical success. You have to actually do the expensive, risky trials. And the tacit knowledge within that tiny team is probably hard to replicate quickly. That self-delivering aspect, if it holds up, is the key thing that could make them different.
Okay, that covers the business and tech side pretty well. Let's pivot to the people in charge and the money situation. Management evaluation.
Right. The CEO is Robert Bitterman. He became CEO in early 2023, but he's been on the board since 2012, so he knows the company. He brings around 25 years of industry experience.
Anything notable in his background?
Yes, actually. The sources highlight that he previously founded and led a dermatology company called Cutania Life Sciences, which was eventually sold successfully.
Ah, dermatology. That ties right into PH762 for skin cancer.
Exactly. Very relevant experience. And interestingly, a couple of other key executives also came from Cutania, so there's likely good team cohesion and specific domain expertise there.
Have they steered the company through any major storms?
No huge single crisis is detailed in the sources, but, for a company like this, just surviving and raising money is navigating a constant storm. They did manage to raise significant cash in late 2024 and early 2025 when markets weren't necessarily easy. That shows capability.
Right.
They also terminated an agreement with another company, Aganox, in May 2024. Probably a strategic decision to save cash or refocus.
How open are they with information, communication?
Seems pretty standard. Press releases, SEC filings, investor conferences. One positive point mentioned was their transparency in reporting trial results, including the good and the not so good, like non-responders. That suggests they're being reasonably upfront. No ethical red flags popped up in the research.
So, quick assessment, honest, capable,
Yeah.
shareholder focused.
Honest. Seems likely, based on the balanced reporting. Capable, yes. The relevant experience, the CEO's past success at Qtenia, and just keeping the PH-762 trial moving forward suggests operational competence, especially given the small team size.
Okay.
Shareholder-oriented. This is interesting. The sources strongly highlight recent insider buying. The CEO, Bitterman, has been buying shares on the open market. His stake was around 1.27% in May 25. Other insiders, too.
That's usually seen as a pretty strong positive signal, right? Insiders putting their own money in.
Absolutely. It aligns their interests directly with shareholders. Now, they are relying on equity financing, which dilutes existing shareholders, but that's unavoidable at this stage if they want to keep the lights on and fund the research. Also, CEO pay in 2024 was apparently below average for similar companies.
So insiders buying is a definite plus point. How are they actually using the money they raise? Capital allocation.
It's going exactly where you'd expect. R&D. Pretty much all of it. They spent about $3.6 million on R&D in 2024, nearly $1 million in Q1 25. And that $12 million or so they just raised, earmarked specifically for the PH-762 trials treatment phase.
No dividends, buybacks, acquisitions.
Nope. Standard for this stage. They're purely consuming capital to push the science forward. Return on invested capital is negative, naturally.
So judging if they're using capital effectively is tricky. It all depends on the trial outcomes.
That's exactly it. Effectiveness here isn't about profit margins yet. It's about hitting those clinical milestones that prove the technology works and move the drugs closer to potential approval or a partnership. You could argue the tiny team suggests efficiency, but it also means they're likely paying a lot for external expertise.
Let's get into the hard numbers then. Financial health check.
Okay, key metrics based on the sources. Market cap around $14 million, give or take. PE ratio, negative, meaningless since they have no earnings.
Right, no profits.
No revenue growth cause no revenue. Margins are negative. Debt to equity is super low, like 0.10x in Q1 25. So very little actual debt.
Yeah, mostly just operational liabilities. That's good. No big interest payments, draining cash.
Not cash flow.
Negative, definitely burning cash. Q1 25 saw about $721K negative free cash flow. $1.3 million negative operating cash flow.
Okay.
Over the last year, around $7 million burned.
And price to book, you mentioned that earlier.
Yeah, it was around 1x, maybe slightly higher. And like we said, for a biotech, book value is mostly cash and the intangible value of the R&D. A PB near 1 just reflects the market's uncertainty and the high risk involved, not necessarily that it's cheap based on assets. The real asset that matters day to day is the cash balance.
So summing up the financial health? Profitable, strong balance sheet.
Profitable. Definitely not. Consistent losses, totally normal for their stage. Balance sheet strength. Yes, but only in the very short term, thanks to that recent fundraising.
Okay.
They had $13.3 million cash end of Q1, then raised another roughly $12.1 million. So a decent cash pile right now.
Yeah.
Very low liabilities. That gives them a very high current ratio, meaning they can cover short-term obligations easily.
But that strength comes only from selling stock, not from operations. The key issue is the ongoing cash burn. That pile won't last forever.
Right. Let's talk runway. How long can that cash last?
Okay, so they had about $13 3Ms end of Q1 25, raised about $12 once real SAGs after that, $9 2 offerings, $2 9 warrants. So maybe around $25.4 million total before Q2 spending. Their Q1 operating burn was roughly $1.3 million.
So doing some rough math.
Yeah, you can see the recent funding, which they said covers the treatment phase of the phase 1B trial, gives them runway for, several quarters, maybe a year, year and a half, depending on the burn rate. But it's definitely not enough for bigger, later stage trials. Phase 2 and phase 3 get much more expensive.
Meaning they absolutely will need more money down the road.
Guaranteed. Probably within the next year or two. This is why getting positive clinical data is so critical for them. Good data makes it much easier and cheaper offer in terms of dilution to raise the next round of funding.
And non-dilutive funding, like a partnership. That's the dream scenario.
Absolutely. That analyst speculation about a potential $75 million upfront payment. While just speculation, it shows the kind of game-changing impact a good partnership deal could have on their cash runway and overall stability. But for now, they're reliant on the equity markets.
Okay. How is the market feeling about PHIO? Sentiment, volatility.
Very volatile. High beta, around 3.17, high price swings. The stock clearly reacts strongly to news.
Like that recent rally.
Exactly. Up big in the short term leading into early June, but still way down over the past year. It's classic speculative biotech behavior driven by catalysts and sentiment shifts.
What about analysts?
Coverage seems pretty thin, only one analyst mentioned by name and one source. And the price targets are all over the place. One source mentioned a high target of $14, another cited $4. One analyst had a strong buy rating.
That huge range tells you a lot about the uncertainty, doesn't it?
Totally. It reflects the binary nature. Huge potential upside if things work, big downside if they don't. Different analysts are clearly making very different assumptions.
And that recent stock price jump was definitely tied to.
The positive pH762 data released in early May, those reports of complete tumor clearance in some skin cancer patients, that's the kind of news that moves the needle for a company like this. Clinical data is everything.
Any signs of heavy betting against the stock? Short interest.
Reported as low, actually, around 1.4%. Doesn't necessarily mean everyone's bullish, could just be low liquidity or lack of interest from short sellers in such a small stock.
Who owns the shares? Any big players?
Institutional ownership is pretty low. Figures varied a bit in the sources, maybe somewhere between 4% and 17%, depending on timing and source. You see names like Citadel, Vanguard, but their individual stakes are tiny, typically under 1%. That's common for microcaps.
But the insiders?
Yeah, that's the more compelling part of the ownership story here. Insider ownership has been ticking up around 3.16% in May 25. And like we said, CEO Robert Bitterman has been buying shares himself. Director Ferrara, too, apparently.
That alignment is definitely a positive takeaway.
It is. So ownership isn't concentrated in a few hands, lots of public float. The insiders aren't controlling the company, but they are increasing their skin in the game.
And corporate governance seems standard.
Yep. Independent directors, committees for audit, compensation, etc. The CEO is also chairman, which isn't always ideal, but they do have a lead independent director for balance. And as mentioned, CEO pay didn't seem excessive based on the 2024 figures provided.
Okay, let's pull it all together with risks. A SWOT analysis based on everything we've discussed.
Sure. Strengths. The INTASYL tech is the core. Focused pipeline. Those early positive pH762 results are key. Experienced team, especially in dermatology, their patents, and maybe that lean operation if it's efficient.
Right.
Weaknesses, big ones, no revenue, burning cash, limited funds for the long haul, very early stage, dependence on that single platform, just being tiny in a field of giants, low analyst and institutional following.
Opportunities.
Huge potential markets, immuno-oncology, RNAi, lots of unmet needs in cancer. The big one. Landing a partnership, hopefully getting non-dilutive cash, potential to expand the INTASYL platform later, and future data releases acting as positive catalysts.
And the threats.
Intense competition, obviously. The massive risk of clinical trial failure. Most drugs don't make it. Regulatory hurdles, financing risk, just not being able to raise money when they need it, technology becoming obsolete, patent fights, and then there's this external factor. U.S. tariffs.
Right, the tariffs. Explain again how that hits a small biotech like Phio.
It's kind of insidious. The sources point out the biotech industry heavily relies on imported material. Something like 90% use imports for over half their stuff. So new tariffs, like those mentioned on EU and Chinese goods starting around April 2025, directly jack up manufacturing costs. For Phio, using outside manufacturers, CMOs, that means their costs go up and their cash disappears faster.
Accelerating the burn rate.
Exactly. Plus, tariffs mess with supply chains. Finding new suppliers takes time, costs money. This could hit critical, specialized components needed for INTASYL, potentially causing delays or shortages.
It's not just cost, it's actually getting the stuff they need.
Could be. And managing that is tough for any company, let alone one with 5 employees. The unpredictable environment also makes investors nervous. And the added costs put way more pressure on small companies like Phio compared to big pharma that can absorb it more easily. A bio warning was even cited about this disproportionate impact.
So, bottom line on tariffs for Phio.
Faster cash burn. Bigger need for more fundraising, meaning more dilution. Potential delays to their research and trials. It hits their biggest vulnerability, the limited cash, really hard.
Okay, so wrapping this all up, the overall picture of Phio.
It's the classic high-risk, high-reward biotech story. Everything, absolutely everything, rides on the science working out. Can INTASYL deliver? Can PH762 succeed in larger trials? They're in potentially huge markets, but swimming with sharks. The core investment idea is purely based on R&D potential. Key risks. Clinical failure is number one. Running out of money is number two, made worse by the burn rate and maybe these tariffs. Competition, and just the risk that the tech itself doesn't pan out.
Not a traditional value play at all.
No way. No earnings, no cash flow predictability. The value is entirely speculative, based on probabilities of future success. No margin of safety here in the traditional sense.
The outcome feels pretty binary then.
Very much so. Either the science works, they navigate the funding and regulatory path, and there's potentially a big payoff through commercialization or a partnership, or it fails at some point and the investment could go to zero or close to it.
Okay, so here's the final thought, the question maybe for you to ponder.
Yeah.
You've got these early intriguing positive signs from PH762. You've got an experienced team, a unique platform concept. But does that potential realistically outweigh all the headwinds? The tiny scale, the relentless need for cash, the crushing competition, and now these extra pressures like tariffs?
That's the billion-dollar question, isn't it? Or maybe the $14 million question in this case.
It really is. Now, this deep dive into Phio Pharmaceuticals, it was actually requested by one of our members. And you can get prioritized deep dives like this too.
That's right. First step, if you haven't already, please like this video and subscribe to the stockanalytics.ai YouTube channel. It really helps us keep producing this kind of analysis.
And for our members, it's just $4.99 a month. You get a special perk. You can literally give us a stock ticker, and we'll prioritize doing a deep dive on it for you, looking at analysis or earnings, pulling from multiple sources, just like we did today.
So definitely hit like and subscribe to stockanalytics.ai on YouTube.
Before we go, we have to read the disclaimer that came with the source material we used for this analysis.
Okay, here it is. This report is for informational purposes only and does not constitute financial advice, an offer to sell, or a solicitation of an offer to buy any securities.
The analysis presented is AI-generated and based on interpretations of the provided research snippets, which are dated as of early June 2025 or earlier. The information herein may not be fully comprehensive, current beyond this date, or free from errors.
Investing in microcap biotechnology stocks like Phio Pharmaceuticals Corp, PHIO, carries a high degree of risk, including the potential for complete loss of investment.
The company is in an early stage of development, faces significant competition, and its success is dependent on factors such as clinical trial outcomes, regulatory approvals, and its ability to secure adequate financing, all of which are highly uncertain.
Readers should conduct their own thorough research, due diligence, and consult with a qualified financial advisor before making any investment decisions.
The authors and publishers of this report are not responsible for any investment decisions made based on the content of this report. Past performance is not indicative of future results. All forward-looking statements involve risks and uncertainties that could cause actual results to differ materially from those anticipated.
Phew! Got it all.
All right. Thanks for joining us on this deep dive into Phio Pharmaceuticals. We'll catch you on the next one.